you allow me, let me give some background.
Sure.
So first of all, the way our tax laws work is that the income that is taxable in Kenya is income that is accrued or derived from Kenya. And it's broken down into various categories: business income, employment income, interest income, amongst others. So under Section 3 of our Income Tax Act, business income is subjected to income tax effectively based on the nature of the income that is being derived. If it's the case of the individual, an individual like a sole proprietorship for that matter who conducts business, then you're taxed based on the graduated personal income tax rates. So effectively starting from 10% all the way now to 35%. And in the case of a company, at 30% corporation tax.
Yeah.
Under the provisions of the Income Tax Act, one is allowed to take deductions for expenses.
Yes.
So the deductions that you're allowed to take are business expenses. So for example, if you're a businessman and you drive from point A to point B to go and deliver your goods, that expense is a deductible expense. If, for example, you're a business person and you buy appliances or goods for your business, that is a deductible expense.
Yeah.
So typically what we'd find is, let's take a typical businessman, someone who is operating a kiosk that sells various products. Your expenses that are deductible is the cost of the goods that you bought. Perhaps you have electricity, that's a tax deductible expense. From time to time, maybe you buy milk for your people, the people that you employ in your business, that is a tax deductible expense, and so on and so forth.
Yeah.
So what has now happened is that there's certain things are not tax deductible. So typical non-tax deductible expenses are maybe capital expenses. For example, if you build a building, that is not a tax deductible expense, you capitalize it.
Yeah.
Certain things, for example, of a personal nature, if a business owner takes goods and uses them personally, the cost of those goods is not a tax deductible expense. What has now happened is that Section 16 has introduced a new category of items that are not tax deductible. And effectively it says that any goods that are not supported by an electronic tax invoice are not deductible for tax purposes.
Yes.
Now, most businesses in Kenya would usually have what we call a VAT ETR invoice. And some years back, it's a number of years ago, electronic tax invoices for VAT purposes were introduced, which means that every single business today that is VAT registered is required to raise an invoice for purposes of charging VAT.
Yes.
What has now happened is that for income tax deductibility purposes, a new system has been introduced called eTIMS, and eTIMS is effective from 1st of January 2024. So it's a new system that was previously not there, but has now become applicable. Now, the rationale for it, for all intents and purposes, is what we call expanding the tax base. And if you look at the rationale that has been given in Parliament, the rationale that the Ministry of Finance, now called the National Treasury, has given, it says that if you look at the net sum of taxpayers in Kenya, or people who file tax returns, the statistics tell us that I think the last year or the year before, only 6.1 million people filed their tax returns. It's now improved. They're aiming at about getting 8.5 million. But out of those, the active taxpayers in Kenya are only 2 million. You have a country that has over 50 million Kenyans. So the question that has been arising
and 14 million registered voters.
And 14 million, 18 million in the last election. 18
yes,
million
18 million
registered
actually,
voters.
yes.
So the question that has been arising has been a very simple question. Why do you have such few people paying taxes or who file their returns when you have a country of so many people? And the answer has lied in the answer has been the fact that these people do not have any system that allows them to either be detected or allows for compliance in any form or shape. So the rationale for the electronics, for the eTIMS, is a very simple rationale. You want to bring all these people
into the tax
who otherwise conduct business on a daily basis, who should otherwise be paying taxes, you want to bring them all into the tax bracket.
Yeah.
And the only way of forcing compliance is to force those people who buy products from them to only buy from people who provide an electronic tax invoice. Yeah, that is a rationale.
Yeah.
So what they have tried to do is to simply say, if you want to take a tax deduction, you who runs a business, you are only allowed to take a tax deduction from someone who has provided you with an electronic tax invoice.
Yes.
Simple, right? So on the face of it, it sounds like a great idea. Yeah. Now, the challenge that has arisen, or the challenge that is likely to arise, is that you have the system under the provisions of the Income Tax Act, and then you have the provisions under the VAT Act. Now, under the VAT Act, the provisions provide that if your services that you provide have not reached the VAT threshold of 5 million, basically, if you take the net sum of all your sales, if your sales don't reach 5 million in a year, you're not required to register for VAT purposes, right? So in practical terms, if you do not make sales of 416,000 every month, yeah, effectively you'll not be required to register for VAT. And it's logical because one of the principles of tax is simplicity.
True.
So if it becomes so difficult for you to comply with tax because, if you're a guy who has a small business who will never make 400,000 in a year, then it seems rational in a way for you to say that don't register for VAT because you're already below the threshold and we're okay for you. The VAT that you would otherwise generate from your business does not justify the cost of compliance. Because for someone who has sold goods worth 5 million, or even if you hit the threshold of 5 million exactly, 16% of that, give or take, the cost of compliance is going to be much lower, much higher than the registration. Now, where the mismatch is arising is that under the provisions of the VAT Act, the provisions are such that, for all intents and purposes, if you are below 5 million or below, you need not register. For eTIMS, for the longest time before we saw the regulations, anyone at all who is in a business generally must register for eTIMS.
Yes.
And that means that the person you buy milk from, the person who sells you flowers by the roadside, to a business that wants to take a tax deduction, must provide you with a tax invoice. It's not enough for them to give you a handwritten receipt. They must give you a tax invoice that is issued through this system.
Yeah.
So there was a lot of concern as to this issue, and everybody was wondering how practical is it that every single business expense that I now need to be taking on board must be captured on eTIMS, and the person who is providing me with this service must actually provide me with an electronic tax invoice, either through some form of computer, maybe a smartphone. The system is yet to be fully run out, but it requires some form of computerized system, which then means that it will possibly lock out a lot of people out of the general trading environment. So what has now happened is that the electronic tax invoice regulations have been issued. Now, we haven't seen the final. We have seen some draft regulations that have been circulated online, have been circulated on various forms. In Kenya, for you to know that something is actually gazetted, you have to see it in the Kenya Gazette.
Yeah.
And the Kenya Gazette that was issued last Friday,
the
regulations were not there.
Yeah.
Which means that we're now waiting for these Fridays. But one of the provisions that you alluded to, paragraph 10 of the regulations, provides for such a number of either incomes or a number of individuals who need not register for eTIMS.
Yeah.
And one of them that has been mentioned there in paragraph 10H, it refers to anyone who has not yet met the threshold of 5 million shillings or below.
Annual turnover.
Above.
Yeah.
Annual turnover.
Yeah.
So what that means to us for now, based on the draft regulations that we have seen, is that this mismatch that could potentially arise, where someone is not registered for VAT for purposes of the VAT regulations, but must be registered for eTIMS, that mismatch is likely to be removed.
Yeah.
However, you're very right that from the time that people saw that regulation, people began asking, how practical is it? And is it going to create a big challenge for the person who accepts a handwritten invoice against the promise or the assurance that is being given by the supplier that the supplier has not reached the 5 million threshold? So it is now the case that people are very worried about the evidential threshold that they will have to demonstrate to the Revenue Authority to confirm that their supplier has not reached the 5 million shilling threshold. The real challenge that arises with this regulation is that the burden of proof to prove that 5 million threshold has not been reached
Lies with.
will not lie with the person who alleges that they have not reached the 5 million threshold, but will lie on you, the person who has bought the services from that person. Because when KRA come for an audit, they will ask you who bought the services,
True.
confirm how you satisfied yourself that the supplier of your services had not reached 5 million. So it's a conundrum.
Yeah.
But we have to wait and see the real final draft regulations in order for us to know whether this provision has been included
Or not.
or not.
Let me hold you there, Daniel Ngumi, and we take a very quick break. We shall be back with a build-up on the point he has just raised around the evidential requirement of proving the 5 million turnover. Stay tuned. And welcome back to this conversation. We are discussing with Daniel Ngumi from Anjarwala and Kana, the eTIMS provisions and the regulations, and we'll be a bit snappy in this section. So, Daniel, you've raised the issue of the conundrum that we are in. Yeah. And the question that I've asked myself is, why is this thing being made such a big issue? Why can't we go the route of saying, for instance, carrier can issue notices of exemption? And I know administratively that would be a lot of work, but I don't understand why this thing has been taken as such a big matter.
I mean, listen, you know, it's the key question is, how do you confirm to a supplier that the person who is selling to you or providing you goods is below the 5 million shilling threshold? Now, there are perhaps many solutions that can be thought about. One solution is that on an annual basis, someone gets a confirmation at the beginning of the year,
Yeah.
almost like the way you get a tax compliance certificate. You get a tax compliance certificate that for the previous year and in anticipation for the next 1 year, your turnover is going to be below 5 million, right? The challenge is that, the 5 million test is a moving threshold. In fact, when you look at the VAT Act, it says that if you are reaching if you sell supplies worth 5 million or anticipate that you will sell supplies worth 5 million, you're required to register.
Yeah.
Now in January, you don't know whether in May or June or July or in September or even in December, you will hit that threshold. So it's a tricky thing because the government then, or the KRA in particular, will have to then, if they're going to give a certificate of exemption,
Yes.
be taking a view that even if this person hits the threshold within a period of 12 months, that certificate remains good for that year, in anticipation, because there are people who will have to rely on that certificate for purposes of getting the tax exemption.
Yes.
Now, I don't know where we will land on this issue, because as it stands, paragraph 10H of the draft regulations, we are hearing in the market that could be deleted. We haven't seen the final regulations.
Yeah.
You only know what the law says until when you see the gazetted regulations. So it sounds like that even within National Treasury, the people who are drafting this regulation, they're equally thinking about what are the solutions behind this. But I think what most people are saying, when you listen to a lot of the people who have read the draft regulations, the one principal concern is we need to find a system that makes it easy to comply, simple to comply, and we don't want to have two levels of standards. One that a threshold that exists for VAT, and no threshold for eTIMS.
For eTIMS.
Otherwise, there'll be a myriad of challenges in compliance, and practically, a solution can be found. I think one thing that is clear is that other countries have gone through this process. Other countries, for example, India, have now rolled out a very good eTIMS system. So the opportunity for people to learn from other countries exists. That's one issue. The second thing that I think we also need to bear in mind is that lawmaking and making of regulations is a process, not an event. So what that means is that sometimes you can get it wrong. So maybe the thing to do is allow for these thresholds to exist. See what happens in the course of 1 year. If you tweak it as you move along, or you take a view. Now, we have to be careful, however, because we also want to have tax laws that remain constant for a period of time.
Yes.
So maybe the thing to say is allow for the exemption to exist now in order for you to have the two, to have concurrence between VAT Act and eTIMS. And then in 2 or 3 years' time, look back and see how well it's being effected.
I see.
Bearing in mind that, tax is a process, not an event.
Good point there. And one of the things which also stood out for me in the draft regulations, as you've called them, is initially we saw when we were invited for public participation, eTIMS was meant to capture stock levels for everyone. If you look at the draft, then there's a bit of modification. When you look at it, do you feel that's a step in the right direction, or how do you assess it?
Well, I think it's a step in the right direction. The regulations, and just to explain, eTIMS covered a number of things. It covered the requirement for the invoice to be of a particular, to capture certain information, but it also went to capture the stock levels that a business should have or ought to have in terms of recording in and out, right? So I think the modifications are geared towards making it easier to comply, but even that is going to be challenging because, when I think about these regulations, my mind keeps going to the person who is selling rose flowers by the roadside, the person who is selling milk in the gallons, to businesses, the person who brings it by way of the piki-piki and tuk-tuks and the likes. I mean, I really struggle to see how they themselves today are keeping, very accurate stock levels. So I struggle to see how that compliance will work in practical items. I mean, in practical circumstances. Having said that, as I said, other countries may have done this better than we. So the real work that the lawmakers need to do is to spend some time interrogating keenly what have other countries done to make this a success, and how can we adopt that for Kenya.
But Daniel, you know, Kenya talks about widening the tax base year in, year out. And I think for all intents and purposes, why don't we get moving with the eTIMS as it is, and wire out the kinks as we move on?
So I think there's a clear intention on the part of the government to move on with eTIMS. So when you look, the law is in force. It entered into force on 1st of January 2024. Media reports say that it had to be, the reason why it had to be delayed until March 2024 is because as of January, only 6,000 people had registered, out of a potential 600,000 to 1 million businesses that exist in Kenya, or registered businesses, if I put it that way.
Yeah.
So effectively, the percentage of compliance on 1st of January was very low. But every intention shows that the government is going to implement eTIMS. So it is moving. Yeah. I don't think that, that this is going to be stopped by the delays in terms of trying to clarify what the regulations provide for. At the very least, we fully anticipate that by 1st of April 2024, it is going to be a system that is operational for the whole country.
Yeah.
And businesses have taken this very seriously. So, for example, businesses that already comply with ETR, many of them are checking ETR for VAT purposes. Many of them are checking, do they need a new system, or can their system be modified in order for the system to comply with both eTIMS and ETR, which is the simple and straightforward thing to do. And we certainly hope that businesses will get that clarity in the days to come. But I think ultimately, because of the bigger agenda, that people who are paying taxes need to increase. And it's actually a constitutional issue because, you know, the principle of equity in the Constitution effectively means that everybody should carry their fair burden of taxation, right? So I see this as something that must be fulfilled. I think from what I'm seeing from government, they are very keen to ensure that eTIMS takes off. Yeah. I think where we do need a lot of input from government is sorting out these sort of discrepancies, because I don't think it's going to be possible or go towards the canons of taxation of simplicity, amongst others, for you to have a test that is applicable for VAT law and a different test for your income tax. Yeah. The two tests must be the same. And the only way we can see that practically happening is to say that if you have met the threshold for, if you're below the threshold for VAT, then naturally it should follow that you should also be below the threshold for eTIMS. Now the challenge is that you should not then place the onus on a business to demonstrate that the person you bought the goods from or the services from was below 5 million. Because if the burden is placed on the wrong person, who is the buyer of the services, then you will make it impossible for that person to buy. You're as well saying, don't buy from someone who is not
deal restrictively with only those who are on eTIMS on board. Daniel Ngumi, thank you so much for your time.
Thank you very much.
Fortunately, we have to close it
Thank you.
At that point. And when he mentioned April 1st, 2024, remember there was an extension window given by the Kenya Revenue Authority. But to clarify, that was for the non-VAT registered taxpayers to be onboarded on eTIMS. If you're already VAT registered, of course, Jan 1st did apply for you. And again today, the Kenya Revenue Authority issued a public notice indicating that the VAT filing for this year is indeed pre-filled or auto-populated because of the eTIMS factor. So this comes into play. We shall continue highlighting these things. We are certainly waiting for the final regulations to give you the latest update on things as they stand. So stay tuned to Business Redefined.
Was it clear?
Very clear, very clear.
That's what I like to hear.
Someone is calling you. I'm sure that's feedback you are receiving.
This is a plumber.
Well, no, boss.